exceptional long-term investment returns from the outset, private equity has evolved quite a bit since we started out 4 decades ago. After leaving Bear Stearns to start our own firm, we had $120,000 between the three of us. $10,000 each from George and me, which was about all we had at the time, and $100,000 from Jerry, who was 20 years our senior. With $120,000 in the bank, we went to raise our first fund, a $25 million private equity fund. Keep in mind, there were no such funds in those days, and there was no one doing what is now considered private equity. Given this environment, we had a difficult time raising the $25 million on terms that we felt made sense. So, we had a thought. Why don't we go to 8 individuals and ask them to put up $50,000 each for a 5-year commitment, and in return, we'd give them the ability to come into any of our deals. And if they did invest, we'd take 20% of the profits, what is known today as carried interest. How did this happen? George's father and my father were in the oil and gas business, where in those days there was something called a third for a quarter. If you had a lease and wanted to drill, you put up 25% of the cost and found someone to put up the remaining 75% of the cost. Consequently, that person gets a 2/3 interest for what they put down, and you get a 1/3 interest. When applying this concept to our own business, we thought 20% was close enough to third for a quarter, and that's still the standard today. When we first started doing deals, private equity transactions, better known as leveraged buyouts at the time, were in their infancy. The PE industry as we know it was not yet born. In fact, we never imagined we'd ever use the term industry when talking about what we do. Private equity deals looked very different than they do today. The asset class was new, and so too was its level of sophistication. As PE explored elaborate capital structures, new sources of funding, larger pools of equity capital, and did so through variable economic conditions, we did not properly explain these complexities or our mission to the public. As a result, PE deals became associated with hostile takeovers at the time. Referring to PE as corporate raiders or barbarians, the public's reaction to the very same question I asked you, what is private equity, was simply an investment vehicle to acquire, strip, and sell an asset for profit. We never thought of it this way. We were always focused on the opportunity at hand to create value at the companies in which we invested. Nonetheless, we and others did not pay enough attention to communicating this with our various stakeholders. Looking back 40 years later, this is one of the many lessons, and perhaps the hardest, that we've learned along the way. These lessons, and the headlines referencing barbarians that came with them, are not exclusive to KKR. The experiences of the early days of PE served as a catalyst for transformation of the entire PE industry. I think it is safe for me to speak on the industry's behalf when I say we have learned there is so much more to investing than buying low and selling high. As my colleague Bill Cornog will expand upon in Chapter 13, we've learned to think of ourselves as industrialists. When we buy a company, we ask ourselves, what can we do to make it better? How can we create value? What constituents should we be mindful of and will factor into a good outcome for everyone? At KKR, key to answering these questions is the development of what we call 100-day plans. These plans are put into place as soon as we make an investment. That means we hit the ground running from the day a transaction closes. Our goal is to focus with a sense of urgency on the creation of value. As part of this process, we establish upfront operating metrics. These can often reveal underlying problems with the business before those problems can be seen in the financial data. In this way, we can make difficult operational and personnel decisions as early as possible in the process. Recognizing, acknowledging, and addressing problems up front are part and parcel of the successful ownership model. This value creation process involves not only understanding a company's balance sheet and financial statements, but also its employees, their impact on the world around them, and being good participants in community.